While Banner Bank has grown from a small thrift bank serving the community of Walla Walla, Washington, to a regional bank operating across 4 states, they have remained committed to building and maintaining strong relationships within those communities and have positioned themselves to be powerful competitors in the regional banking landscape. We are the Whitworth CFA team, and 3 primary reasons drive our buy recommendation for Banner Bank, with a target price of $61.65, representing a 12.4% upside. First, Banner's focus and footprint in a region of strong economic growth drives loan origination. Second, Banner's industry-leading asset quality improves profitability and mitigates risk. And finally, Banner's segment-leading net interest margin provides for a strong net interest income, even in challenging rate environments. Banner's revenue is driven primarily by loan revenue, of which commercial real estate is the primary component. However, commercial business makes up a significant portion of both the portfolio and future appetite, as noted by Chief Credit Officer Rick Barton in the 4th quarter conference call. Banner operates 184 branches across Washington, Oregon, California, and Idaho, pulling the majority of their deposits from Washington. Since the American West acquisition in 2015, Banner's been focused on strategically entering high-growth markets such as Sacramento and Los Angeles along the I-5 corridor. Economic indicators such as GDP growth are primary drivers of loan origination, and Banner's entry to this market presents a strong opportunity for organic growth in the future. A bank's board of directors is also essential as they navigate the complex banking landscape. Although Banner's staggered board structure negatively impacts the value of the company, Banner has been focused on adding high-quality members to this board. The 3 newest board members have backgrounds in technology and public accounting, which will help Banner remain relevant in the competitive banking landscape.
As explained to us by Linda Elkin, Regional President of US Bank, the market in which Banner operates in is competitive. Banner competes against national banks, other regional banks, community banks, and credit unions. Still, Banner's share of deposits across Washington, Oregon, Idaho, and California increased 9.3% over 1 year. One area in which Banner excels in is their customer satisfaction. According to J.D. Power, Banner has the highest customer satisfaction ranking out of any bank in the Northwest and the 3rd highest in the country. In the banking industry, technology is becoming increasingly important, as explained to us by Dan Yates, CEO of Endeavor Bank. Customers are continuing to spend less time in physical branch locations and more time interacting with digital channels. Banner has been keeping up with industry trends, as seen with their highly rated mobile app and intelligent ATMs. One of the largest challenges for regional banks today is heavy regulatory burden. Since crossing the $10 billion asset threshold, Banner is now subject to the Durbin Amendment under the Dodd-Frank Act. Additionally, they are subject to minimum capital adequacy ratios set by the FDIC, new and existing FASB accounting standards, and other regulation under Congress, such as RESPA. Mergers and acquisitions are a staple of the regional banking industry. Banner's 2 most recent acquisitions were Alta Pacific and Skagit Bank, with deal values of $87 and $180 million respectively. Unfortunately, not all of Banner's recent acquisitions have been accretive. Looking at the last 5 years, we found that Banner's market cap is 6.6% lower than it would have been had their acquisitions been as strong as their peer group. However, this is not a major cause for concern, as one of Banner's main intentions with these acquisitions was to increase their total asset value, thus reducing regulatory burden and containing expenses for shareholders. Still, it is important for acquisitions to be accretive in Banner's future.
Banner's Common Equity Tier 1, or CET1 capital ratio lags off comparable peers and has been declining over the last 5 years. Banks set their own internal capital goals above the standard of 7% required to operate freely. However, it is possible for a bank to be overcapitalized. As stated by Banner's CEO Mark Raskovich in the 4th quarter earnings call, Banner's prudent deployment of excess capital is part of the company's strategy to build shareholder value. When speaking to the CEO of the Bank of Idaho, Jeff Newgard, he stressed the importance of asset quality. Compared to peers, Banner's net charge-offs as a percentage of loans are far lower. This is in part because 98% of the loans fall into a reliable loans risk category, versus an industry average of 95%. As stated by former Banner loan officer Mark Conrad, Banner's high asset quality is driven by their prudent lending practices, which allow them to maintain a lower risk profile and in turn mitigate losses due to default or economic downturn. In addition to high asset quality, Banner displays a segment-leading net interest margin. Even a 1% cut to the federal funds rate would leave Banner's NIM above the current peer average of 4.03%. This strength is founded in a consistent and low cost of deposits. While Banner operates in areas of high growth, their actual deposit base lags the deposit base of their overall regions as a whole. This economic underperformance of Banner's deposit communities is evident in drastically lower GDP growth, median income, and wage growth. By taking deposits from these low growth communities and lending them in faster growing communities, Banner is able to remain profitable and competitive. All of this disparity between Banner's deposit and loan communities has had an impact on the regulatory CRA rating. They still within acceptable standards and not expected to increase the regulatory burden.
In light of Banner's regional growth, high asset quality, and industry-leading net interest margin, we employed a multiples model and a terminal value model, weighted equally against each other in order to arrive at our final target price of $61.65. Within our multiples model, we did not use the peer group that Banner identifies because these banks varied widely in terms of size, structure, and geographic scope. Instead, we selected peers with a similar asset size, loan portfolio, regional nature, and history of acquisitions. It's worth noting that two of these banks, First Merchants and Great Western, aren't located in the West. However, they met these criteria and were therefore comparable to Banner. Our model uses forward PE due to its high degree of accuracy in predicting fair value and tangible book value due to its use in M&A activity within the industry. Combined, these ratios and peers give us a target price for our multiples model of $60.31. Our second method of valuation was a terminal value model. This model considers the present value of three factors: the company's CET1 surplus or deficit as compared to the internally set capital goal, future dividends, and terminal value. CET1 is included in this model because it represents excess capital that can be distributed to shareholders through either special dividends or share buybacks. We projected each of these items in base, upside, and downside cases. The base and downside cases both foresee a recession in 2021, with the downside being more severe, while the upside sees a continued period of moderate economic growth until a recession in 2024. In order to estimate the company's internal target for the CET1 ratio, we examined its history of special dividends. We estimated the target ratio to be 10.8% and projected our surplus or deficit in each case accordingly. In order to project net income and future dividends, we employed linear regression and Monte Carlo simulations. We compiled a list of 23 key macroeconomic drivers and used their historical growth rates to run 10,000 simulations for each balance sheet item and used the results to forecast each case. We then applied appropriate interest yields and costs based on consensus rate estimates and the underlying economic environment in each scenario. Non-interest revenue was projected through its dependence on total deposits, while non-interest expenses were projected through the efficiency ratio. These items, combined with a tax rate of 21%, gives our net income for each case. Ordinary dividends were then projected as a percentage of net income. Combined, these items gave us a target price in each of our cases. When the base case at 60%, the upside at 15%, and the downside at 25%, we arrive at a target price for our terminal value model of $63. Weighted equally with the multiples model, this gives us our final target price of $61.65.
While Banner faces various risks, we highlight three. Risk one, dependence on underlying economy. Economic conditions and consumer sentiment have a significant impact on Banner's performance, leaving them exposed to adverse economic events. The impact of a downturn would be notable as non-performing loans would increase while loan origination would stagnate. However, Banner's industry-leading asset quality and their capital surplus create a cushion in the case of economic decline. Risk two, failure of acquisitions to add value. Because Banner's past acquisitions have diminished shareholder value, it is important for them to be accretive moving forward. Risk three, fintech and online banking. Technology is rapidly changing the banking landscape. However, while fintech and online banking may pose some risks, they are more often regarded as potential partners by both regional banking officials and fintech firms. So how soon should we expect Banner to meet its target price? To answer this question, we performed 10,000 Monte Carlo simulations based on the historical growth of Banner's stock price. Our results indicate that Banner will likely reach our target price in 1 year and will almost certainly reach it in 5. In conclusion, we believe that Banner Bank is significantly undervalued because it is well positioned to leverage regional economic growth, because it issues high quality loans, and because it enjoys an impressive net interest margin. We believe Banner is a sound investment. As a result, we issue a buy rating with a target price of $61.65, representing a 12.4% upside. We thank you very much for your time and look forward to answering your questions.
So you guys kind of highlighted 3 of the risks to Banner Bank. Would you think that interest rates would be a risk? And if we did see an interest rate or 2 cut, how would that affect kind of the profitability and margins of Banner Bank?
Yes, to speak to interest rate risk, and in many ways this is tied closely with the economic risk, as interest rates will follow the economic situation. We find that Banner is very highly rate sensitive. More than 60% of their loan portfolio is in a floating rate structure. And Banner has a 256% higher interest rate sensitivity to a 1% cut in the federal funds rate than the industry average. However, and as Jason mentioned earlier, Banner does enjoy a really strong net interest margin. And because of that, even a 1% cut would leave Banner's net interest margin above the current peer average. So while a decrease does represent significant risks to Banner's net interest income, it still allows this interest rate sensitivity allows Banner to capitalize on interest rate increases.
Can I just make sure I heard him correctly? What did you say about their sensitivity to a rate decrease?
Absolutely. So they're 256% more sensitive to a 1% decrease than the industry average.
Okay. Appreciate it.
And then I was kind of looking through the financials, and it looked like the non-performing loans actually doubled in the fourth quarter of 2019. Do you guys know where that kind of came from? And then relative to like maybe 2008, which was a great financial crisis, how those numbers might compare?
Yeah, absolutely. So in the fourth quarter conference call, they spoke directly to a singular credit relationship, which drove that increase in the non-performing loans. And what it was is a single agricultural loan of about $30 million, which due to headwinds in that very specific industry caused the loan to become non-performing. So we find that that is a singular one-off situation. And while it does pose a serious risk if that singular credit line were to default, we believe that Banner should be able to recover it. They have a strong history of recovering loans in the past. As far as comparing it with the recession in 2007, 2009, I don't think it's a similar or comparable event, as it's not something that's being faced by the entire agriculture industry, let alone the entire commercial business, commercial real estate industries as well.
Also of note is the fact that despite the fact of this failure of this significant relationship, Banner's net charge-off as a percentage of loans was still about 35% lower than their peer group. So they still do have really strong asset quality.
Slide 10, you guys talked about the acquisitions they've made, Alta Pacific and Skagit. Do you know what they paid? You put the price paid there, but do you know what the multiple was on earnings or book value?
Yeah, absolutely. So here you can see the multiple on both price to earnings and price to tangible book. Price to tangible book is probably the one we would find to be most relevant because it's a pretty common metric in the regional banking landscape. As you can see, there's some disparity here. The industry average in the West is about 195%. So Alta Pacific was relatively cheap compared to that, while Skagit was more expensive.
Great. Thanks for that. And then on slide 16, you guys did the multiple comparison versus the peer group. And I guess from that analysis, I guess Glacier obviously stands out. Why is that?
So Glacier has a very comparable loan portfolio to Banner.
Mm-hmm.
The one outlier to them, I guess, would be that they have outlined more potential acquisition targets. And so because of their outspokenness in terms of saying they are planning on being more involved in future M&A activity, then the market is pricing them at multiple higher than the peers. But aside from that, they are very comparable.
To emphasize to the extent to which that is true, the company identified about 300 chartered banks within their area of operation, and out of those 300, they identified over 200 of them as acquisition targets.
And that was Glacier or?
Glacier.
Glacier did? Okay. Gotcha. Okay. Billy, if you have a question.
Great, yeah, so just so I understand, so with their commercial real estate portfolio, are those loans more floating rate or fixed rate, or what does their commercial real estate loan portfolio look like?
Yeah, absolutely. So within each different section, Banner does not directly disclose. They do disclose a more overarching glimpse of what the floating versus fixed structure is. Banner puts a really big emphasis on floating rates, largely because we are in this low rate environment and enjoying the ability in the future to benefit from those floating rates makes it appealing for Banner. They do even enter a derivatives hedging position where if a customer wants a fixed rate, they will give them a floating rate and then enter into two separate interest rate swaps just to retain that floating rate scenario for Banner. So floating rates are a very large percentage for Banner. As far as the actual amount of commercial real estate, I don't have a firm number on.
So are they a balance sheet focused loan portfolio, or do they do CMBS where they're selling to the secondary market? Or do they mainly use their balance sheet for their loan origination?
Yeah, so as far as the secondary market, that is more of a player in mortgage loans and 1-4 family residential. Within actual commercial real estate, they hold on to a majority of those loans.
Okay. And then how do you guys see the coronavirus affecting their business model, kind of current state, and then if the pandemic were to accelerate, how do you see that impacting?
Well, in one sense, Banner is not particularly exposed more than another firm might be to the coronavirus, given that a lot of their lending is in areas that wouldn't necessarily be impacted by the coronavirus, things like just residential construction, things like that. So we would think that maybe in the near term, the limit of that risk would be fairly low. In the long term, I mean, obviously it's very difficult to project what's going to happen with the coronavirus. The information is often suspect and difficult to deal with, or difficult to trust, difficult to know how accurate it is. And so long term, it's much harder to evaluate what the risk of the coronavirus is.
Okay, so then my follow-up would be, how could the coronavirus or some other kind of black swan event affect kind of interest rate policy, and that interest rate policy have an impact on their business?
Yeah, absolutely. So to speak to that, when Federal Reserve Chairman Jerome Powell spoke and testified to Congress recently, he spoke on a number of different issues, but among them, he was questioned about the coronavirus. And the Fed has positioned themselves as still remaining a wait and see, even during this coronavirus, though the Fed will act if this is looking like it's going to have a severe impact on the global economy. So that's something that we really need to watch closely. Again, and as Jacob noted, it's hard to really know what the coronavirus will end up being.
Question on their loan geography. Do you guys know what that looks like? I think you had a breakdown of their segments, consumer, commercial. Okay. And which area do you think is their focus to grow, given that pie chart? What geography?
They are placing a heavy emphasis on California. As that map showed, they have opened branches in California organically. That's where their Alt-Pacific acquisition has been. The markets that they operate in within California far exceed the national average in terms of GDP growth, and so that presents significant opportunity to capitalize on loan demand in those areas.
Mm-hmm. Is it going to be organic, or do you think acquisitions?
The company hasn't spoke as to acquisitions. However, acquisitions are a possibility, but as far as organic growth goes, we spoke with CEO of Endeavor Bank, Dan Yates, who operates and founded several banks in the Southern California area, and he said it's very easy for banks to capitalize on organic growth there, especially for a bank like Banner, because larger businesses in those areas are sort of served by Bank of America, JP Morgan Chase, but locally owned businesses with 1 to 2 locations, they don't really have smaller banks that can cater to those markets, but there's still a huge demand. And so for a bank like Banner, there's significant opportunities for organic growth.
Great, thanks.
How are you guys looking at market share between smaller regional banks like Banner and larger banks with the kind of emphasis on technology and then brick and mortar being a lot more expensive than some of these online banks?
Sure, so one of the big positives for Banner for their customer satisfaction is actually the fact that they do have more physical locations. A lot of their branches are in rural areas, and those people are the ones that tend to adopt technology a little bit slower. So that's one reason why their customer satisfaction is so high. Additionally, they have been doing really well with their mobile banking app. When we spoke to the Banner officials in our kickoff meeting, they explained that a mobile app is more of something that everyone is going to be in line with. It's not a big differentiator. But as you can see, their rating in the Apple App Store is high compared to their peer group, and they are catching up significantly to their larger banks, such as JP Morgan or Bank of America.
That's just about time.
Great job, guys.
Thank you. Oh, yeah, we'll see.